Brad Williams, Frugal Finance, convertible mortgage. With a convertible mortgage, the lender has the option to purchase all or a portion of the property after a predetermined amount of time. The term convertible mortgage refers to the ability of the lender to convert the mortgage into equity ownership through this purchase option. This arrangement gives the lender the right to purchase a call option, which gives them the ability to purchase a portion of the equity in the property at a predetermined price when the option expires. It can be thought of as a hybrid of a traditional mortgage and call option purchase. Let us take an example where a $700,000 convertible mortgage is used to finance the property. This mortgage covers 70% of the property's value and gives the lender the option to purchase 65% of the equity at the end of the 5th year. The interest rate on this mortgage is 8.5%, which is less than the 10% rate on a conventional loan. It will have monthly payments over the course of a 30-year amortization schedule. In return for the conversion option, the lender accepts the lower interest rate. The price that the lender pays for the call option is reflected in the 150 basis point difference in interest rates. Assuming the property is financed with the described convertible mortgage and the lender exercises its option to buy 65% interest in the property after 5 years, we present the investor's after-tax cash flows in Table 1216. Since 65% of the estimated price, $753,528, exceeds the mortgage balance, $668,432, at the end of the 5th year, it is anticipated that the lender will exercise its option. Stated differently, when the option is exercised, it is in the money. We also assume that the investor will sell the remaining 35% interest in the property for comparison's sake. Yield of the lender on a convertible mortgage. Lenders receive a yield from convertible mortgage that is not solely determined by the interest rate applied to the loan. It also accounts for any prospective profit in the event that the mortgage turns into property ownership interest. The lender's yield is just the loan interest rate if the mortgage isn't converted. Assuming the borrower honors the terms and doesn't default, that represents the baseline yield. The lender's yield on the convertible mortgage surpasses the loan's 8.5% interest rate in the particular case that was previously discussed. This is a result of the profit realized from turning the mortgage balance into a portion of the real estate. This profit results from the conversion option included with the mortgage being deemed in the money time of exercise. In this instance, the mortgage lender thus gains a 65% interest in the property valued at $753 at the end of the 5th year. In addition to receiving monthly payments of $5,382, you would take these actions to determine the lender's effective yield. Loan, $700,000. Market rate, 10%. Convertible rate, 8.5%. Loan to value, 70. Terms of loan, 30 years. I'm highlighting this because you're going to input this yourself. Conversion rate, 65%. Monthly payments. Just going to use this payment formula. So we can go equals. Remember this one? Formula text. So we're just going to go formula text. We're going to point here. And voila. Isn't that nice? And then we can just copy this down. Why? It's just convenient. And then hit F9. Estimated value, 753. This is a given. So you're going to input this. Lender's yield, we're going to put this green. Why? Why not? So more colors. Go over here. Pick something obnoxious. 1039, edit, copy, edit, paste. We're going to use this present value deal. What are we doing? This is hard-coded. We should reference the 64. Where's that 64? The challenge here is determining the lender's yield. We're going to take 60 is your term. And the question is, where did this 64589 come from? That comes from this net operating income. We took 64589, divide that by 12. We're going to use this 53,528. You see this value right here, 53,528, and then the 700 grand. To determine the lender's yield, so your net operating income divided by this differential, 5328, is what they're gaining. They're going to gain this 10.39%, and it's 0.39% above the current lender rate. There's a summary, and this information, just threw this together. It's meaningless. All we did was capture some minimal information. We have this cell, 753. It's not information that is that pertinent. And then you have your internal rate of return. You go back to the third or fourth previous examples. I probably illustrate this, and I just copy pasted this thing. If not, you can just create this pro forma, whatever numbers you want. You can play around here. You know how to do this internal rate of return now. You know how to do this after-tax cash flow. This reconciliation makes sense. That's entirely up to you. Whether this is an acceptable after-tax cash flow and whether your tax situation is prudent, well, again, this is just a hypothetical. You can use whatever data you want. Brad Williams, Frugal Finance. See you soon.